Welcome back to The Explainer. Today, we're diving into a massive disconnect. I mean, it's literally a canyon between what we're all told to do with our money and what the wealthiest people actually do. You know the drill. Everyone says, just save your money, but almost nobody shows you where the money actually goes. Well, until now. If you're like most of us, you probably feel this really relatable frustration. You've been doing everything right. You put money away in a savings account every single month, and then at the end of the month, you check your banking app to see your grand reward. And it's $11. $11. That's barely enough for a fancy coffee these days. Meanwhile, you open your phone and read that some hedge fund manager just made $40 million while literally sleeping. It's like we live on the exact same planet, but we are playing completely different games. Section 1. The Investment Canyon. Okay, let's dive into this because we really need to look at the macroeconomic reality of who actually owns the wealth in the stock market. Now, fair warning, what you're about to hear might make you genuinely uncomfortable. The richest 10% of Americans, they own 89% of all U.S. stocks. And if you look at the bottom 50%, we're talking 66 million households here, they own just 1% of stock market wealth. I'm just going to pause for a second and let that land. 66 million households sharing a tiny 1% slice of the pie. The top 0.1%, just 134,000 households, actually own more equities than the total combined wealth of the entire bottom 50%. That isn't just a gap, that is a canyon. So while that top tier is having a totally different conversation, the rest of us, we're caught in the savings account trap. For generations, the safe, responsible move was putting your money in a fixed deposit at the bank. But the rules stopped working. Inflation happened. Think about it. If your savings account is earning, say, 3 to 4%, but inflation is running at 6 to 7%, your wealth isn't growing, it's shrinking, slowly, surely, every single year. The whole system changed, and nobody bothered to tell us. Section 2. The Gambling Zone. You see, that massive frustration with slow, shrinking savings, it led to a major cultural shift. Right around 2020, investing kind of became entertainment, and finance turned into a dangerous sport. Welcome to the gambling zone. Crypto created this whole generation of people who really believed they could get rich right from their phones. I mean, Bitcoin went from under 10 grand in early 2020 to nearly 69,000 by November 2021. People were becoming actual millionaires from their bedrooms. But then, in 2022, it crashed by 64%. And remember 2018? It dropped 80% then. This perfectly illustrates how this asset is literally 5 times more volatile than the broad US stock market. It's totally driven by hype and fear.
But honestly, I get it. I really do. The generational split in this data is just fascinating. Check this out. 28% of young American men own crypto, while only 21% actually have a retirement account. Crazy, right? But why? Because traditional investing feels painfully slow. When you're scrolling social media and watching someone brag about a 400% return on some random meme coin or an options trade, sitting on boring index funds feels like bringing a bicycle to a drag race.
But here is exactly what happens when that drag race car drives off a cliff. Treating finance like a sport has devastating consequences. Things like options trading allow you to borrow money to make bigger bets, which means a bad trade can erase your entire position in hours. Sometimes it even leaves you owing the brokerage money. No way, right? And in 2023 alone, the FBI received over 69,000 complaints related to crypto fraud. That totals $5.6 billion in losses. $5.6 billion. Suddenly, that boring $11 savings account doesn't look quite so bad, does it? All right, let's shift gears to Section 3, how the ultra-rich invest. Now, what's really interesting here is when we pull back the curtain on the actual playbook of the top 0.1%. It reveals a massive shift. Because, spoiler alert, they aren't playing the crypto lottery. Sure, they hold roughly 70% of their financial wealth in equities, but for the very first time ever, among the world's 330 largest family offices, their allocations to private capital at 29.2% have actually edged out their investments in public equities at 28.5%. So, what does this all mean? It means the wealthiest families on earth are literally pulling money out of the public stock market to buy entire companies. While we're out here buying one share of a stock, private equity firms buy the whole shebang, restructure it, and sell it years later for an enormous profit. And when we look at exactly where they park their cash, high net worth investors put, on average, 32% of their wealth into real estate, 26% in equities, and 21% in commercial properties. Wait, so they actually hold more in property than in stocks? Why? Because real estate generates consistent monthly cash flow. They're rich by the building, we rent from the building, and the building owner invests what we pay them. Honestly, that is the whole system in a nutshell. So the absolutely crucial point here is that the ultra-rich obsess over 4 core things. Number 1, ownership, like actual ownership of businesses and assets. Number 2, cash flow. That's income that arrives whether you're working or not. Number 3, tax efficiency, because legally minimizing your tax bill is how wealth compounds so much faster. And number 4, time. Nobody ever learns in school that legal tax efficiency is a primary wealth strategy, but it is for sure one of the biggest ones they use.
Okay, section 4, the boring wealth strategy.
So where does that leave the rest of us? The problem with most of these finance explainers is they show you what the rich do and then just leave you feeling completely hopeless because, well, you don't have millions in capital to go out and buy a skyscraper. But here is the brilliant irony of it all. Warren Buffett, literally one of the greatest investors in history, has repeatedly given this advice. Most normal people should just buy a low-cost S&P 500 index fund and hold it for decades. An index fund basically owns the 500 biggest companies in America. So the guy who consistently beats the market is telling ordinary people to stop trying to pick individual stocks and just bet on the entire economy not collapsing. So here are the exact 4 actionable, albeit boring, steps to building real wealth. First, build an emergency fund of 3 to 6 months of expenses in a high-yield savings account. And I don't mean a regular one earning 0.01%, but a high-yield account earning 4 to 5%. Second, kill your high-interest debt. Paying off a 21% credit card is the investment because literally no market beats that interest rate. Third, if your employer matches your 401k, take it. It's literal free money, folks. And fourth, consistently buy broad market index funds. That's it. That is the boring version of what the wealthy do. Just so you know, U.S. retirement assets and IRAs and 401ks now total over $35 trillion, built quietly year by year.
Now, let's look at the sheer mathematical power of those boring steps compounding. If you invest just $500 a month, starting at 25 years old, at a historical average 10% annual return, by the time you hit 65, you would have roughly $3.2 million. $3.2 million just from $500 a month. That is the absolute magic of compound interest. It rewards patience.
What actually bothers me about all this isn't that the rich invest differently. It's this realization right here. Nobody told us there even was a different game. Our parents worked hard, they saved, they did everything they were told to do. But nobody explained index funds or compound interest in a way that felt personal or accessible. Feeling left behind isn't a personal failure. It's a systemic gap in access to information.
And the data absolutely proves this. 68% of upper-income Americans are invested in the stock market, compared to just 14% of low-income Americans. That gap isn't just about money either. Financial literacy changes the choices available to you. Understanding these concepts ensures that the next generation doesn't have to start from zero. The best time to start was 10 years ago, but hey, the second best time is right now.
But just as you're feeling all empowered and ready to start your index fund, your phone buzzes with a breaking news alert. Markets fall 3% as recession fears grow. Yikes. So the ultimate question is, what actually happens to all of this when the market crashes? Well, make sure you join us for the next explainer, where we're going to unpack bear markets and discover exactly why most people panic at exactly the wrong time. See you then.